Hello everyone, and welcome to the explainer video of Real Estate Financial Model Template by AUT Financial Modeling. This real estate financial model is a comprehensive, fully integrated Excel-based template that is designed to analyze, forecast, and value income-generating real estate assets. The model is suitable for commercial real estate investments and can be used by investors, developers, asset managers, analysts, and lenders to evaluate any project's feasibility, financial performance, and valuation. The model is structured in a clear modular format, allowing users to input assumptions efficiently while automatically generating financial statements, valuation outputs, key matrices, and a visual dashboard. So I'll walk you through each of the sheets that are there in this model and explain you how this works and how the assumptions need to be input so that we can get the desired output. So first I'll start with the dashboard that is there. So in this dashboard there are certain matrices that are there and some of the valuable outputs that one would like to see if they are invested in a real estate project. So what I'll do, I'll just walk you through the assumptions first, then we'll come back to this dashboard. So here is the assumption sheet. In this model you'll see that all the inputs that need to be done by the user are in light blue, that is the font color is in light blue, and those in black are the outputs. So herein you can see we need to start by inputting the start date of the project, then the area unit that we'll be using to measure our properties, then the currency, then we have some capex assumptions such as land acquisition, renovation works, new furniture cost, and here we have the total of our initial capex. Then we have our capex schedule, like how are we going to spend this capex. So the year shows that year 0 means before the project is already started, and phase 1 means in the first year of the project, hence the phase 2 and phase 3 mean the year 1 and 2 of the project. Then we also have debt drawdown schedule that we can input, that is connected to the debt schedule sheet. Then we have our yearly ongoing capex assumptions, some of the rent and cost related assumptions such as annual increment in lease, leasable area from the available land. Then we have occupancy rate. This is the rate that we expect to fill our property spaces when current lease on the property gets expired. Then we have inflation, operating expense assumptions such as service charges, management charges, maintenance charges, insurance, accounting, brokerage, and other expenses. Then we have our financing terms, which is the interest rate, loan repayment. This total debt has been calculated based on the capital structure, which is how much debt and how much equity we want in our capital structure to be. Then we have some tax depreciation assumptions and all of that. Then we have also our DCF valuation terms. So at the end of the project, we will have a terminal value of our property and we want to find out what's the current worth of that property. So we'll use DCF valuation terms in that. Then we also have initial acquisition cost, how much we'll need to pay per square feet to acquire the properties. Then we have type of leasable spaces such as a retail space, office space, industrial, logistics, and parking space. So now I'll explain you the tenant roster assumption sheet. Herein we have the leaseholder, the type, the gross floor area. From this we have a list of leaseholders. Then we have the type of leaseholder. Then we have the gross floor area, which needs to be input by the user, and then a leasable area gets calculated based on the assumption that we have taken. Then we calculate the rental price per month from the rental price per year that we need to input. So also we need to input the details about the lease duration, such as when it starts, how long it will stay. So the ending date automatically gets calculated. So the tenant roster works like this. And then we have the actual calculation of tenant rent. So herein the rent is calculated on a monthly basis. So this is an assumption that the lease uh, doesn't get renewed at the end of lease duration. So you'll see the rent will stop coming after some period of time because our initial leases expire. And herein we have the rent, assuming that the lease doesn't get these is renewed. Here we have the assumption that the lease gets renewed after the end of their initial time period, and we would maintain a 90% occupancy rate. Herein you can see. So this is also a monthly format, and after that we also have an yearly format wherein we can see at the end of each year how much rent we have generated and what was the occupancy. So yeah, this was the tenant roster sheet. Then we get to the expense sheet wherein the expenses get calculated. So these are pretty straightforward, and we have talked about it in the assumption sheet. Next we have fixed assets schedule wherein we have the capex spend schedule. Here how much we are willing to spend in the first year, second year, third year of the total capex that is required. And here we have the distinguish capex, just land acquisition, other initial capex, the ongoing capex, and tenant improvement charges. So that's how we calculate the total capital expenditure. And then we calculate the fixed assets that are land and buildings. So our land doesn't get depreciated over the years, but our building values will take the burden of depreciation. As you can see, we add up the additions to the book value. So herein you'll see it's 687,000, and in the next year after additions it becomes $1,064,620. Next we have the depreciation schedule. So in each year the depreciation works like this up here. Then we calculate the depreciation for each year, and next we calculate the net value of a building and property, and that's how we calculate the net fixed asset, which includes land. The next sheet is the debt schedule, and it shows how the debt is being drawn down. So in the assumptions we said the debt needs to be 100% drawdown in the first year itself, and then we have a note saying the drawdown is assumed to be happening at the start of the period date, and the repayment will be happening at the end of the period date of the project. So here we have principal amount, repayment year, the interest rate, the drawdown percentage. Yeah, that we have here. Then we have debt balance at the beginning, and we have how much debt has been drawn down, how much we need to repay, and what will be the debt balance at the end of this period or year. Then we calculate the interest here. That's how we calculate the debt service so that we can know how much payment is going towards the interest and how much payment is going towards the repayment of principal. The total is called debt service. Next we have our P&L calculation, which is pretty straightforward. We have rental income, other income, then we subtract the operating expenses. After After that, we get the EBITDA, gross EBITDA, it's EBITDA percentage. Then this is the gain or loss that we have at the end of period if we decide to sell the property. Then we have depreciations, interest, we get our earnings before tax. Then we have our income tax and capital gains if we decide to sell our property. Then we have a net income. Next is a balance sheet that is pretty much straightforward. We have our assets and liabilities plus equity, and there's a check placed here which ensures that the balance sheet is always balanced. Then we have our cash flow statements. We get our net cash flow from operating activities, then net cash flow from investing activities, which lead to unlevered free cash flow that is available to the business. Then we have cash flow from financing, and at the end we have the net cash flow and the opening and closing cash balance for each period. This is a calculation of our debt and equity amount that needs to be put up to get the business running. And here we have our DCF valuation. We have our rental income, unlevered free cash flow. So we are valuing these cash flows in terms of today. So that's why you apply a discount factor. And also we give a terminal value to the property when we exit this, so that at the last year if we decide to sell the property, this will be the terminal value that we'll get. We apply the discount factor to that as well, and that's how we get the discounted terminal value. So we add both of these up and we get the DCF value of property. Then we have some matrices such as occupancy percentage, or occupancy percentage after renewals or without renewals, gross yield as a percentage of property value, net operating income as percentage of rental income, net yield as percentage of property value, levered free cash flow without exit or with exit, unlevered yield such as percentage of property value, and the area leased and rental income per area leased. We have a couple of charts here also. The first one shows the rental income and the net operating income as percentage of rental income. Next is a split of contracted rent and the renewables. As you can see, in the later years the contracted renewables form the major part. Then we have a line showing the occupancy rates that are there. Then we have a chart showing property yields. One is showing gross yield as percentage of property value, and second one is showing net yield. Then we also have a cash flow chart which shows the net cash flow. You can see in the first year it is down and then it picks up. Then we have the closing cash balance, which keeps on piling up. So now I'll share the dashboard with you. So this is the dashboard. We can input whatever year for which we want the results, and all the values get changed to those. So we have our revenue figures here for the year 2029, our SG&A expenses, our cash reserve, remaining financial debt to be paid, EBITDA margin that year, what is the net income that year, and the occupancy rate. So this needs to be in percent, not in percentage, in dollars. We'll fix that. So herein we have equity and debt funding that we require to run the business. Then we have year 2035 details. We have some matrices such as the DCF value of property, the gross yield that we have generated in the year 2035, the net yield and the unlevered yield, and also the area that has been leased in terms of square feet. On the right side, you can see there's a chart which shows the financial debt in the red line, which is constantly going down. We also have a closing balance of cash, which keeps on going up as the time passes by. And at the bottom, you can see a line that is for debt service. So it tells us the amount of money we are paying to service the debt. So yeah, this was the dashboard. And if you guys have any questions or you want to understand some other parts of the model, you can leave a comment in the description and I'll be happy to explain those your queries or any sort of questions you have. I'll be happy to explain them in the comment sections. And if you want to have access to this model, you can check the link in the description. It'll take you to a store and wherein you can also check the other financial models that we have done, such as the solar power plant model, the electric car model, hotel business development, mobile app development. So you can check those out as well. So yeah, so with that, I'll sign off and until next time, I'll see you later. Thanks.